Hello, fellow value investors. I'm coming at you with a review slash overview for a book on value investing principles. I would say that I just finished up, and I would recommend, straight up coming out of the gate, I'd recommend the book. The book's Richer, Wiser, Happier by William Green, not by me. The presentation's by me. So what the book is, William Green, he got interviews with all these great investors who have beat the market over decades, and it gives you their insights into investing. It gives you also their insights into life, but it gives you a lot of different viewpoints on investing, and it's part of why I would recommend it. It's a great starting point. I think it might actually be the book I start recommending people to get into this kind of field of investing because it shows you many people. It doesn't really focus on the technicals. What it does focus on is kind of the mentality, the discipline, the fundamental ideas, their life stories, the trades they made, how they advise on life. And it kind of lets you see the ones who fit you. Because of this book, I went off and decided to read Howard Marks' book next because I liked his chapter and it sounded really interesting, right? So it's a great jumping off point into all these other ideas. It doesn't stick you to one idea. It doesn't say like if you're not doing what Ben Graham does, you're not a value investor. I don't even think it says the word value investing, but every single one of these people at some point it's like, oh yeah, Ben Graham or Warren Buffett or Charlie Munger or whoever, they inspired me. I didn't get the stock market, and then I read their book and it was also clear, right? And it's those people, they're like progeny, I guess is probably the right word. So the pros, as I just said, it covers a ton of different views, and you can kind of pick the one that like fits best for you. And a point it makes is that you should be doing something that you believe in fundamentally that makes sense to you, and you can't be doing what other people are doing. So the idea it gives you a lot to look at and find the one that fits is great. It focuses on the soft skills around investing, and he gets some very exclusive interviews with some pretty reclusive billionaires. Now, what I don't like about the book, hitting you with some cons, even though I think there are a lot less, there's survivorship bias. There's survivorship bias in any investing book. Nobody wants to read an investing book from the guy who was right but lost all his money, right? That doesn't sell. People are willing to listen to the guy who was wrong and got lucky and made a ton of money, right? And you never know. You never know in investing if people are getting lucky or if they're right. So there's always that. There could be plenty of people who did exactly what they said and they went broke and they're not getting books made about them. It does front load the best interviews, I think. The ones where he gets really exclusive access and he's with these people for like a week. It puts those up front. They're all talking about Charlie Munger in the book, advertises Charlie Munger. And all the people up front, you get Mohnish Pabrai up front, and Mohnish Pabrai is being like, oh, I love Charlie Munger. I love Charlie Munger. And it's like, oh, we're going to get a Charlie Munger interview. The Charlie Munger interview, he sits down with him for 10 minutes, right? And he just says a bunch of stuff, at least for me, as I've already read a ton of stuff about him. There was nothing new in there. And then there isn't any numbers stuff, but I think that's actually kind of good for intro for the philosophy part. I think it's actually for the best. I wouldn't like this book to sit down and talk about return on invested capital. It does a bit in the like Greenblatt section, but anyway. So first, we're going to talk about Pabrai and what Pabrai talked about in the book. Now we're going to go through a lot of the big headline ones. It's probably a little more than half of them. As you get further in the book, the interviews are a little less, and they get like a third of a chapter each, and it's less important people. And that's another thing I didn't like because suddenly I'm like, okay, we got a chapter on this person, and then like 5 pages later, it jumps to a different person. Like I didn't like that. Bring me back to the last guy. Anyway, we're going to start with Pabrai. So Pabrai talks a lot about shameless cloning. He talks about just copying. Don't reinvent the wheel. Other people have figured a lot of this out. Go figure out the smart people. And this is something I say a lot in real life. Warren Buffett went from kind of $0 to kind of the richest person on the planet. I'm just going to listen to every word that guy has to say. I'm not going to try and reinvent the wheel. It saves you a lot of time, a lot of effort. People have already figured out what works, and you can just copy them. He's been trading for the last like 30 years, 26 years, if I did the math. And his big wins where he invests a lot in kind of companies people haven't heard of that are at super low valuations. He says somewhere in there that like every time he buys a company with a double digit PE, all his friends are like, oh my God, this isn't the Pabrai I know, right? He buys like companies that can't go wrong. He talks about like heads I win, tails I don't lose much. And he likes looking in like foreign countries where no one else is looking. You know, he's always buying like some, I don't know, Indonesian mining company at a PE of 2. That's the kind of stuff he's always looking at. So he's kind of trying to find really great risk-adjusted returns, I would say. So here are some quotes I picked out from Pabrai. I'm a shameless copycat. Everything in my life's cloned. I have no original ideas. That's something he's hammering home the whole time. I picked this one out. It's more of an excerpt from the book, but it's something once a lot of them say. Buffett, with Munger's help, had laid out the laws of investing, which are as fundamental as the laws of physics. Buffett's style of investing seemed so simple and so powerful that Pabrai considered it the only way to invest. When he studied other money managers, he was perplexed to find that almost none lived by Buffett's laws. It was like meeting an entire set of physicists who don't believe in gravity. And once again, I feel this way when people are going crazy on technical analysis and whatnot. Like, I get it, but these are the laws of physics. Things will come back to this eventually. And you get this from a lot of them. I'm not going to quote them all. They almost all say, like, I was lost and then I read Graham's book or something. How do you win the game? You've got to play according to the rules. And the good news is I'm playing against players who don't even fucking know the rules. This is another important thing. Disagreeing with an efficient market hypothesis is, I would say, another pretty big tenet of value investing. If you truly, truly believe in an efficient market, a perfectly efficient market, you should be a boglehead, right? You should just go and invest in the index and let the efficient market, it's unbeatable. There's no way to beat it. But understanding that a lot of the market participants are idiots, there's a ton of inefficiencies. And this is him saying that, you know, these people that don't understand the laws of physics, I can beat them because I understand the laws of physics. And there's a lot of people participating in the market who don't. And then these were some of Pabrai's lessons. Clone like crazy. I think we already talked about that one. Hang out with better people. Oops, missed a word. When I meet someone for the first time, I evaluate them afterwards and say, will it make me a better or worse to have a relationship with this person? This is something I've been doing in my real life more and more. I meet some people and I'm like, I'm going to be a better person with a more interesting life if I keep this person around, or this person's going to drag me down. And he's always thinking that. Who's going to lift me up? Who's going to drag me down? On top of lifting people up around you, who's going to lift you up? He believes in extreme concentration. You're going to see all over the place with these guys. But he believes in having like 5 to 10 positions, having 10% of your net worth in a stock that you really believe in. He says a lot that, you know, you're only going to find so many good pitches. If you can't make 30 good decisions, you can't know about 30 good companies at good valuations at a time, but you can find like 8 probably, and you can be really sure of them if you have a few. His heads I win, tails I don't lose framework. He's always looking for things with very limited downside, very unlimited upside. This is a Graham thing. Ben Graham says that buying at a low price is one of the only things in the stock market that increases the reward and lowers the risk. The lower price you get in, the higher your eventual reward will be, and the lower the risk you're taking is. But people treat it the opposite, right? And then live by an inner scorecard. He preaches about it and not caring what other people think about you, not thinking about what other people think about you, not making trades based on what other people are doing, or if other people think your trade's bad, or if the market thinks your trade's bad. He talks about positions where he's down like 67%. He's not even worrying about it because he knows he's right. And eventually those end up 10xing, right? So the next one we're going to talk about is Sir John Templeton. This was a guy I had never heard of before. I had heard of Pabrai, even though I didn't know a ton about him. I had heard of him. Templeton never had crossed my radar until this book. He's more from Graham era of like World War II, pre-World War II even, when there were some crazy deals being offered. The market was crazy inefficient, and really is totally nobody knew what they were doing. He talks about extreme contrarianism. He's very conservative. He had some personal views I don't totally agree with. I think I included a quote of one of them. He's very like religious and believes in like crazy work ethic. He doesn't believe people should retire. There was some weird stuff. But his defining trades were one, when World War II started, the whole U.S. market crashed. Everything crashed. And he said, I did an analysis and I think this is actually going to be good for the US market. And he was right. And he called up his broker and he said, buy every stock that's under $1. I don't care what it is. The broker said, okay, there's like 130 of these stocks. But we're only gonna have you buy 90 because the other 40, they're declaring bankruptcy. They've already gone bankrupt or whatever. And he said, no, buy those too. Some of them are gonna recover. Something he talks about a lot is like, he doesn't have the time or patience or information to go and actually study every one of those companies and figure out which ones are gonna survive the bankruptcy and which ones aren't. But he knows if he can buy something no one else wants, there's a ton of reward. Some of them aren't gonna go bankrupt. Some of them will. If half of them go bankrupt, half of them don't. Everything's dirt cheap. These are extra dirt cheap. He'll have crazy returns. He's the kind of person who might buy like a sector ETF nowadays. You know, I'd say like I think that memory is going to go good, but I don't know what memory company or whatever. He probably wouldn't actually buy memory, but you know what I mean. So he would just buy the sector ETF, buy every participant, and hopefully more of them win than lose. And he's right in general, and he's protected from like a single company doing something dumb. His other big trade was shorting the dot-com bubble. On the opposite end, everything was going for insane prices. None of it made sense. He shorted the whole thing. He made a ton of money. So here are some of his quotes from the book. Absolutely nothing will make a stock go down to an extremely low price except for other people urgently trying to sell. You have to buy at a time when other people are urgently trying to sell or desperately trying to sell, he says. That's something he drills in. You have to be willing to buy when no one else wants to buy. And you have to be willing to sell when no one else wants to sell. And that's what they all talk about. That's what you always want to do in hindsight. You look at a chart and the back test it. You're like, oh, I would like to buy the bottom and sell the top. But then the bottom happens and it's terrifying and you're scared to buy. And then the top happens and you think it's going to go up forever. So that's kind of what he talks about. You have to be willing to make that call. Here's one of his like kind of personal life quotes that gives you an idea of who this guy kind of was. He was talking like this the whole chapter. That's why I had to include it. This is like all of his interview was him saying stuff like this. I've never thought it wise to pursue pleasure. There must have been some deeper reason why God created human beings. And one of the fairly obvious things is that the people who are busy with some really useful work are happier than the ones who are idle. Like I said, he thinks people shouldn't retire until like their bodies physically not able to move. He doesn't think people should like retire and go on vacations and stuff and enjoy their golden years. He just thinks they should keep working and contributing to society, and how much further society would be along if no one ever retired. If a person were going to own stocks and bonds, it would be much wiser to search everywhere rather than limiting themselves to one nation. And this is something you get once again a lot in this book. A lot of these guys are saying look outside the U.S. market. There's always risks with it, but there's some crazy rewards because you're looking somewhere a lot of other people aren't. My biggest position's NVIDIA, and I think they'd all disagree. I have my reasons, but I think they'd all disagree with that because from their point of view, it's the most looked at stock. From my point of view, I think it has like the biggest company can't get bigger discount. Let me hide my camera for this so you can read these. Here's some of his lessons. Beware of your emotions. His quote: most people get led astray by emotions in investing. They get led astray by being excessively careless and optimistic when they have big profits, and by getting excessively pessimistic and too cautious when they have big losses. Another one: beware your own ignorance. So many people buy something with the tiniest amount of information. They don't really understand what it is that they're buying. This is something I've also been working on a lot, reading the 10Ks and all that, doing research, really checking the bull and the bear cases, going back, looking at the history, looking at their future. And I used to just buy companies off some really low information, and like one simple check would blow up my whole thesis. Diversify broadly. Once again, the opposite of Pabrai. Investing is so difficult, he concluded, that even the best investors should assume that they'll be right no more than 2/3 of the time, however hard they work. The moral: get your ego and your risk exposure under control. Don't put all of your money with any one expert. Don't put all your money in any one industry or any one nation. Nobody's that smart, so the wise thing is to diversify. Patience is key. This is another value investing principle I think they would kind of all agree with, that you have to wait to be right. The market in the short term is crazy, right? That's a Graham fundamental. In order to have some really good investment results, all you need is patience. He warned almost all investors are too impatient, adding people who change from one fund to another as often as once a year are basing it more on emotion than investigation. There's another one: find bargains among poor performers with temporary causes. His contrarian strategy involves scrutinizing stocks in beleaguered industries. Which one is the lowest price compared to what I believe it's worth, right? He'd be looking at 52-week lows, and that's where he'd be shopping. He's looking at things that have gone down, once again, have higher reward and lower risk. Things that have gone up have higher risk and lower reward. So he's going to look at things that have gone down. Don't chase fads. And this guy shorted the dot-com bubble, so that's big for him. The best way for an investor to avoid popular delusions is to focus not on an outlook, but on value. He suggested that we ground ourselves in reality by investigating an array of specific valuation metrics, including a company's market price in relation to its sales volume per share, its net asset value per share, so he was a net guy in the grammar, and its average earnings per share for the last 5 years. So I think that paints a totally opposite picture. Let me turn my camera back on, of Templeton versus Pabrai. And it's what I like about this book. It gives you two totally different views, but they are both definitely value investors, both inspired by Graham and Buffett and Munger, right? Well, in his case, Buffett and Munger came after him, but you get the point. They're all value investors, but totally different. And you can pick which one sounds right to you and which one you believe in, so you can stick with it. Okay, so Howard Marks is the next one we're going to talk about. And he's one of this book actually got me to go and buy his book, and I'm reading that book now. Maybe I'll do another report slash overview on that book too at some point. He focuses on second level thinking a lot about risk, and thinking about where we are in market cycles, and acknowledging what you don't know. The reason I was drawn to him is because he focused a lot on like buying debt and bonds, which is something I haven't looked too deeply into. He seemed to have some pretty cool ideas about the market at kind of next level. He learned from some of the people I learned from, and then he's added his own layer. He thinks a lot more about the market participants. He likes buying from forced sellers, which I don't think is something you'd hear Buffett talk about. He is worried about the people on the other side of the trade. He talks about like when a stock goes up, that means that like everyone who can be liking the stock likes the stock, and at some point it can only go down because some people are going to change their opinions, right? And that creates a cycle. So he's actually worried about the people in the market and what they're doing and how you can read and play off that a bit, while also being obviously a very fundamentally a value investor. So some of his big trades in the 90 recession, he got some crazy good value on distressed bond yields. He looked at it, he said, well, everyone tells me these things are uninvestable, which means there must be some great deals there because all the people who know what they're doing they're not willing to touch them. If I'm willing to touch them, I can find some great deals. In the dot-com bubble, he wrote a bunch of memos about how this thing was looking more and more like a bubble. He reduced his risk, and he dodged a lot of the crash. And then in 2008, when the housing market crashed, I don't know if you've seen the movie Margin Call, where there's those guys with their CDOs and they're selling them off for 10 cents on the dollar. He hopped in, he started buying the other side of that, made him a lot of money. People were selling for 10 cents on a dollar because they were being forced to sell. But he said, well, they're probably actually worth like 40, 50, 60 cents on the dollar. So I could 6x my money buying these dog shit mortgages that are all going to go, that are all going to fail. But he said they're still worth something. They're not worth 10 cents on a dollar. They're worth more than that. So he was one of the guys on the other side of that trade buying from the forced sellers. And those sellers probably would have liked to hold them too if they didn't have to sell them. So that's kind of that's part of his like worrying about who's on the other side of the trade, and that was one of them in 2008. Here's some of his quotes, and this was from 2008. Will the financial system melt down, or is this merely the greatest down cycle we've ever seen? My answer is simple. We have no choice but to assume that this isn't the end, but just another cycle to take advantage of. Most of the time, the end of the world doesn't happen, right? And this is something he talks about. You just need to bet on the progress of mankind eventually. If the world ends, then you're cooked anyway. Don't bet on the world ending. No one's ever bet on the world ending and been right, but it's always going to work that way because the world's still here and we're in it. If the world ended, this book wouldn't exist. One way to combat this costly tendency to forget is through intensive study of market history. You can't know the future, says Marx, but it helps to know the past. Another thing to talk about, he's talking about market history. A lot of them talk about real history too. There are some people who I didn't cover in this talk about like if they're going to a country for market research, they'll like read fairy tales from that country and stuff. Like literally any knowledge can come in and help you. So it's not just about studying balance sheets. He's saying study the history of market bubbles or even the history of history to figure out where things are going, you know? So it's something people talk about a lot is multidisciplinary learning. I'm convinced that everything that's important in investing is counterintuitive and everything that's obvious is wrong. And this kind of plays into his like, well, if it's obvious and it's right, everyone knows it and it doesn't matter. So it's either obvious and it's wrong and that's important because everyone believes it and they're wrong, or it's right and it's counterintuitive, so not everyone's figured it out, and that can also give you an edge. So he's kind of worried about the other people in the market and what's going through their heads a little more than the other guys. So what are his lessons? Admit you can't predict the future. The future is inherently uncertain. Successful investing begins with accepting this reality. Risk derives from the fact that more things can happen than will happen. Study the patterns of the past. While history doesn't repeat, it rhymes. Understanding past market cycles guides his decisions. Cycles inevitably reverse. He's a big cycles guy. No trend lasts forever. Extremes of greed and fear always self-correct. The market can't stay greedy forever, and it can't stay fearful forever. Unless like the nukes drop, I guess. Turn cycles to your advantage. Position your portfolio to exploit market extremes rather than being victimized by them. Behave counter-cyclically. So if you feel like you're in a greedy cycle, act fearfully. If you feel like you're in a fearful cycle, act greedily. It's another way of phrasing what Templeton did, really. Be humble, skeptical, and prudent. Maintain a high margin of safety. Question market consensus. Manage risk rigorously. Uh, Risky behavior over a long enough period of time will lead to catastrophe. I think this is a Buffett thing too, really. So the next investors this time we're going to move on to is Nick Sleep and Qais Zakaria. Might be butchering his name. I didn't look up how to say it. They founded the Nomad Investment Partnership in 2001, ran it till 2014. 13 years, and they 10x'd their money. They actually started the partnership like the day after 9/11, I believe. But they do everything super counterintuitively or opposite of the way it was traditionally done. So they formed this partnership and they said, we're going to 10x your guys' money, however long that takes. And then they did it. And then they ended the partnership and they said, that's what we're here to do. So their core philosophy is scale, economy, shared. So economy of scale is the idea that, as I go from my business needing 1,000 pounds of meat for one store to needing 1,000,000 pounds of meat for 1,000 stores, that my cost per pound of meat goes down. And a lot of companies use that to just increase their profit margin, keep more money to itself, maybe pass more money up to investors, or maybe use it for reinvestment. But they believed in companies that pass the savings on to the consumer. And the reason they believe in that is because it builds consumer loyalty, it builds a moat, and it brings in new consumers. The lower and lower they can get their prices, the more people are hooked on them, the more they get like a cult following. And it shows in their key strategy, which is extreme concentration over the long term in companies with long-term thinking. So in this case, they put most of their money in Costco, Amazon, and Berkshire Hathaway. And I think Costco and Amazon are the best examples of that scale economy shared, where they are companies that just believe in making a great product and always making the product better. And if they have more money using it to make the product better, Costco is always passing savings on to the consumer. Costco, their entire profit margin is their membership fee. And they break even on the rest of it. And the only thing that they make money on is the memberships. And so they're always bringing in more people from memberships, or is making the memberships more valuable. Amazon Prime, similar thing. Probably not the exact, but like still, you get a ton of value from Amazon Prime. You get more than your money's worth from Amazon Prime, and then Amazon uses that to go and dominate all these industries, get all these monopolies, and try and make Amazon a better product, pull you into their ecosystem. These are companies people wouldn't give up their Costco or their Amazon membership for like anything, because they're such good value, and it brings in people and it makes them giant. They grow by just offering such a good product that more and more people come from further and further or whatever to get the product. It's similar to Nebraska Furniture Mart, if you read the Berkshire Hathaway letters. So here's some of their quotes. The first one, I think I put Nick Sleep. It's actually an excerpt from the book. Costco then shared these economies of scale with consumers by lowering its prices even further. Sleep and Zakaria estimated that its members save $5 for every $1 that Costco kept for itself. The effect of this policy of self-restraint was a virtuous cycle that Sleep sums up like this: increased revenues begets scale savings, begets lower costs, begets lower prices, begets increased revenues. So that's what I'm talking about. These companies that pass the savings on to their consumer and are always expanding their moat because of it. It's harder and harder to compete with them. People who are price sensitive are more and more likely to go to them. They're pulling in new consumers, and they're growing. Every Costco is always getting more members every year. Even without needing to build a new Costco, more people are going to get a membership. More people are going to come from further for Costco as the deal gets better, as they grow bigger. Here's another one. They disregarded all of that ephemeral information that distracts investors from what matters. Sleep notes that information, like food, has a sell-by date, but some of it is especially perishable. Some has a long shelf life. This concept of shelf life became a valuable filter. This is something they talked about when like COVID happened. It's after their fund dissolved, but when COVID happened, they were like, there's all this talk about COVID and how it's going to spread and what industries, like in 2 years, none of this will matter. This is all short shelf life stuff. Where for them, they were looking at the big picture of like, where are these companies going to be further out? I think that's the next quote. They sought to answer such questions as, what is the intended destination for this business in 10 to 20 years? What must management be doing today to raise the probability of arriving at that destination? And what can prevent this company from reaching such a favorable destination? They referred to this way of thinking as destination analysis. So they didn't like companies that were saying like, we're going to get the quarter over quarter revenue increase. We're going to raise the buybacks by this much. They like companies like Amazon that are saying, we're going to reinvest all the money. We have great plans. It might take a while, but like, here's our amazing vision of where Amazon will be in 10 years. And we're doing all the right steps to make that happen. and they bought into that, and they just bought these companies they thought were great companies, and they held them, and they got fantastic returns from it, and they did it in a concentrated way too. So here are their lessons. Pursue quality, buy exceptional businesses with great management, and sitting on your hands becomes the ultimate compounding strategy. There's a lot of talk about quality. I didn't mention it yet, but Sleep like based a lot of his investing philosophy on a book about motorcycle maintenance. And the book talks about how like when you're maintaining your motorcycle, you just got to do everything right. Don't cut corners, don't do it cheap, don't do it fast. Just do it right, and like the results will speak for themselves, and the knowing that you did it right, so reward. And that book said do that in your own personal life too. Treat yourself like a motorcycle you're maintaining. Sleep went and did that in his investing career too, and made his investment fund just something where he was doing everything the right way, and he let everything else follow. Focus on long shelf life. Disregard ephemeral noise. Focus on high quality information with a long shelf life that remains valuable, as well as business models with long shelf lives. So they weren't looking about the hot new thing. They were looking for something that they look 10, 20, 30 years forward, and they see a bright and beautiful future for it. And they're not worried about like getting on what's going to be the next big swing, what's the next tech fad, what's the fashion, whatever. They are worried about something that's building an indomitable moat. Basically, they that would last the test of time. That they had a great vision for the business in the long term, and we'll talk about that more with one of these later ones. Scale economy shared. I think we already talked about plenty. Unethical behavior isn't necessary. This is kind of a Zakaria thing, and it's kind of a thing with the whole fund. You don't need to cut corners to win. Integrity, fairness, and deep rationality are the ultimate long-term competitive edges. Zakaria had an interesting story of how he got into investing, where he was working like sell side during the dot-com bubble, I believe, and he was being forced to sell all these garbage IPOs. So sell side means that you're working for an investment firm that's like making a stock or a bond for the first time and selling it from the company to the public. Normally, when you buy a stock, you're buying it from another person who holds the stock, but he was worried about the very first time the person who buys it from the company. So he was selling stuff on the company's behalf to people, and it was during the dot-com bubble, and he hated it, and he was miserable. And look, he would tell people would say, "I want to buy this," and he'd say, "That's actually an awful thing. They make no money. Don't buy that." And they would buy it anyway, and then they'd go broke, right? And then with their fund, they did that too. They talked about how like they could have done stuff to pump up their numbers in the short term. A lot of fund managers had all these tricks to just kind of track the index, but a little more volatile and beat it a little, or like to do some accounting trickery and make, if they had a bad quarter, make it look good. They also, a lot of funds have a payment method where like if they beat their benchmark, then they get paid a fraction. You know, if we get over 6%, we keep a quarter of everything past that or whatever. They actually like held theirs in escrow to make sure that they beat the market for a longer term, for 5 years instead of 1 year, to make sure that they couldn't just pump up their numbers 1 year. They had to beat the market, the index they were trying to beat, over 5 years. And then they would finally get their reward. And they decided that was the ethical, proper way to do with it, and it would discourage unethical behavior. And it paid off. Next one is short-term crowd advantage. I think this is a big one. The more the crowds obsess over short-term movements, trends, and information, the more advantage there is in looking for long-term opportunities. So a lot of these other people in the book, they talk about like, you go look at international markets, go look at distressed bonds, go look at bankrupt companies, go look at unethical companies, you know, like go do private prisons or whatever. And that's where you find deals because other people don't want to touch it. Well, what they're saying is if everyone's focused on 3 to 12 months out, by focusing 120 months out, by focusing 250 months out, they're already looking at things no one else is looking at. They can look at these big companies, but because they're looking 200 months out instead of 20, that it's the same as going and looking in Sri Lanka, right? Looking 200 months out. And that was their method. And they just bought good companies. They held them for 13 years and they 10x their money, and then they ended the fund. These guys are kind of lunatics in like a really neat and interesting way. Anyway, that's all for them. On to Jean-Marie Eveillard, and it's actually a 5A and 5B here. So Jean's another one I hadn't heard of going into this book, just like the last ones. And he's probably the most conservative investor in this book, as well as the 5B. His years trading were 79, 2009 for the first Eagle Global Fund, and the guy after him, McLennan, he ran it after him, and they had a very similar philosophy. It was kind of the fund's philosophy. His philosophy was value investing with an extreme aversion to permanent loss of capital, prioritizing not losing money over short-term gains and staying true to his deep value picks even when they seemed out of favor. His big career trades were in the dot-com bubble. He refused to invest in the dot-com bubble. He was holding gold, gold and things like that. And when the bubble burst, he protected his clients' wealth, and that led to a big part of his outperformance was he didn't get caught in these bubbles. Even if he was outperforming on the way, or it being outperformed on the way up, he didn't crash when the crash happened, because he just wasn't involved in any of the BS. And he had a deep value allocation. He was always looking for deep value stocks. He also held cash and gold always to keep people safe and to make sure that he had some backup. And when you're running a fund, you need to be able to pay people out, right? So here are some of his quotes. To lag is to suffer. It becomes psychologically painful, but also financially painful. After 1 year, your shareholders are upset. After 2 years, they're furious. And after 3 years, you're gone. So this was kind of him talking about the pain of doing what he was doing. And there were some times where he like almost got forced out of the fund. Everyone's like, the tech companies, the NASDAQ's up. The NASDAQ 4x'd in the last 3 years, and we're up 20%. What the hell? And it's part of why being in charge of funds is always an issue. You always have to worry about your clients pulling money out. I don't know. I think his clients might have pulled money out at some point. That was an issue. He was being forced to sell when he didn't want to because his clients were leaving. Here's an excerpt. Eveillard felt the burden of managing money for hundreds of thousands of investors saving for retirement or their children's education. It's money they cannot afford to lose, he says. If I screwed up, I was very aware of the fact that I was making daily life more difficult for the investors in my fund. That pushed me to try to be cautious. And then another one. Buffett and Munger had the stomach to hold a more concentrated portfolio, but Eveillard couldn't bring himself to do it. I'm too skeptical about my own skills, he admits, and too worried that it could just blow up. This is something he has in common with Templeton. They both talk very similarly in that way. So our 5B here is Matthew McLennan. He took over the First Eagle Fund after Eveillard, and he had a lot of similar philosophies. His key career trades, there weren't that many because really it's just he hasn't lost money, and he hasn't been in charge during that many crashes other than COVID. He didn't get a Dodge.com in 2008 like a lot of these other guys. But he shares the philosophy, and he's continuing philosophy for the fund, and half the chapter was on him too, and there were a lot of quotes from him that I really liked. He had value investing roots. He worries about absolute return, capital preservation, resilience. He's averse to permanent loss. That's kind of the fund's whole thing. Global diversification, holding cash and gold, all that fun stuff. They're, like I said, the most conservative investors in the book. Here's some quotes from him. The first quote: I happen to believe that everything is on a path to fade. If you think of evolution, 99% of species that have ever existed are extinct, and businesses are no exception. So he's basically saying this. If you like look back 50, 60 years and look at the top 100 companies in the stock market, like you wouldn't even recognize most of them now. They've all become irrelevant. And he thinks that'll happen again. He thinks if you look 100 years out, a lot of the companies today will be irrelevant. Like it's all life cycle. They are born and die. It's just like nations are born and die. There's no infinity nation that's been around untouched. Same government for like thousands of years. There's no the companies are living things and they're going to die off, and you need to be prepared for that. An excerpt from the book I liked. He likened the situation to living on a fault line in San Francisco. Maybe we have a great 10 years ahead of us and the earthquake doesn't surface, but it would be foolhardy to act as if the threat doesn't exist. We just want to acknowledge that there are things that may not play out so well in the future, he told me. You want to be structured to participate in the march of mankind, but to survive the dips along the way. And that's kind of what they did with their fund. They just wanted to participate in progress. I know putting money into the stock market is the best thing for everyone's money, but they decided to diversify, not put it in risky, trendy things. They dodged a lot of these crashes, but they kept a good chunk of the upside, not all of it, along the way. So here's another one. It's not enough just to be conservative. You need to be willing to put cash to work when others feel least comfortable doing it. So the same as a lot of these other conservative people, where they're like, just basically buy the dips. Buy when other people want to sell. Don't go crazy when everyone wants to buy. Maybe just hold cash and gold when everyone wants to buy, and then when they want to sell, buy from them. So here's the lessons in resilience from both of these guys and the First Eagle Fund. Respect uncertainty. Acknowledge unpredictable environments like financial fault lines. Build flexible portfolios designed to withstand unforeseen systemic shocks. It's something that they talk about a lot, that there's all these unforeseen shocks. No one saw COVID coming. There's no way to see COVID coming. but you have to be ready for those kind of things, and you have to be ready for a lot of things that aren't going to happen. You have to be ready for earthquakes that won't happen, but you don't want to be in an earthquake, super like earthquake prone house that could collapse if there was an earthquake. And well, I hope there isn't one. So they're kind of saying they prepare for every disaster imaginable, and only like 5% of them will actually happen, but they are ready for those when they happen. Reduce debt and avoid leverage. With luck, you can get away with anything in the short term. With time, the odds rise that your vulnerability will be exposed to unforeseen events. This is something they talk about. I have a little leverage myself, and it's something I'm always worried about. Anything that can happen will happen. If you're in the market long enough and your portfolio set up in a way you could go to zero, then you'll go to zero eventually. Avoid ruin, stay in the game. You want to be structured to participate in the march of mankind, but survive the dips along the way. We already used that quote, but I think that was kind of the core of their philosophy. Like, stocks are the best place for your money, but stocks are crazy and volatile, and they needed to be super diversified. So like nothing can go wrong. Almost their thought. Even if they give up some of the gains when the bad stuff happens, they totally dodge it. They sidestepped it, and that's what led to their outperformance. Beware overconfidence. Guard against intellectual complacency. Skepticism of your own predictive abilities prevents concentrated bets from blowing up. So once again, these guys, there's two very opposite sides of this: the concentrated bets guys and the diversification guys. They do all agree in like not believing in your full total ability to predict everything. Even the concentrated bets people they're not saying they can predict the future. They're just saying they know a good business when they see it, basically. These guys, they barely even pick businesses. He's just picking stuff with dirt cheap valuations, mostly. Margin of safety. Be very aware of the risks you take and compensate, insisting on an equal or greater and opposite discount. Require a strict margin of safety before putting valuable cash to work. So once again, these guys were like deep value investors. They were looking for purchases with such an absurd margin of safety that it accounted for everything that could go wrong and more. So on to Joel Greenblatt next. So next up is Joel Greenblatt, and this was one I actually had heard of. I've read one of his books, The Little Book That Beats the Market. And his core philosophy is basically keeping it super simple, keeping everything simple. And he breaks some things down to formulas. This is one of the few times you get formulas in this book. But he believes in value investing driven by keeping things simple, buy above average businesses at below average prices. Figure out what something is worth and pay a lot less. He pioneered a magic formula. And the magic formula, it's basically like high returns on capital, low PE, low debt. And he made like a screener for his clients, and like an index made out of things that passed the screener. And he mentioned that like he offered a bunch of them the opportunity to like cut out 10%. He's like, here's these 60 companies that pass the screener. You can cut 6 of them out that you don't like. And apparently everyone who did that underperformed and left money on the table compared to the other guys. His key trades, he was big into spin-offs, special situations, liquidations, restructuring, and he got 40% annualized return over his years, where the market gets 10%. And I'm a big fan of spin-offs. Like, IPOs are always trash. Basically always trash, but spin-offs can be really interesting. Sometimes spin-offs, they're just getting rid of the shittiest part of their business and loading it up with debt and kicking it out the door, right? But sometimes the spin-offs, they're actually trying to, get rid of their diversification problem, split off parts of the company so they can thrive on their own. And the really important thing is, and in kind of how our Mark sense, a lot of people then get this share dumped on them from a company they didn't buy, didn't want, don't understand, and don't know what it's worth, and they're just going to sell it. It's like one step removed from buying from forced sellers, buying people who just had these spin-off shares show up in their pocket, or index funds like that are an S&P 500 index fund, and suddenly has the share of this company that's not the S&P 500, they're actually a forced seller. And there's all these people who don't even know what this thing is or where it came from, and they're a borderline forced seller. You can buy them off them if you understand what it's worth for some very deep discounts. And I've made some good money. He's made some good money doing that. On to the next slide. So here's some of his quotes. I have a simple way of looking at things that makes sense to me and that I'm going to stick with through thick and thin. That's it. That's something he kind of emphasizes. What matters is that you believe in what you're doing. You're not listening to other people. You're not doing something crazy you don't understand. You're not listening to gurus. You find something that makes sense to you and you believe in, because you need to stick with it when the market crashes. You need to be able to. Okay, so next one. This is an excerpt. It's a very small fraction of people that can value businesses. And if you can't do that, I don't think you should be investing on your own. How can you invest intelligently if you can't figure out what something's worth? So, first, this is something he talks about. He talks about index investing being a totally passable idea. You can just invest in the index and match the market, and you're fine. And that's what most people should do. But you need to be able to value a business, and that's the core of value investing. If you can look at a business not knowing what it's going for on the stock market and figure out what a share of it should be worth or what the whole business should be worth, everything else works itself out. If I look at SpaceX and I say that company is maybe on a good day worth 600 billion, probably worth 200 billion, I see it's trading for 2.5 trillion. Makes perfect sense. It makes perfect sense why I should do everything's clear. But if you look at it and you say, oh, it's way up, everyone's buying it, maybe it's worth that much, it gets very confusing. Nothing makes sense. It's very hard to figure things out. But if you can look at a business and say, I think it's worth this much, and then you see it's trading for half that or double that, very easy to make the decision. And that's basically what he's saying. Keep it simple, learn how to value a business, and everything else will work itself out. And then here's something he said when he was learning about investing. He was in college and it was during the Nifty 50 bubble. I had a visceral reaction to what I was learning about in school about efficient markets. It didn't seem to make sense to me on a basic level of looking at the newspaper and seeing what was happening. So the Nifty 50 bubble was when there were like these 50 great companies, and all the Wall Street people just said, buy this company at any price, and McDonald's is such a good company, the price doesn't matter. You just want to own McDonald's, it doesn't even matter what you paid for it. So a company like McDonald's was trading for like 80 or 90 PE. So that's what he's saying. He's being taught that the market's perfectly efficient, while McDonald's is trading at 90 times earnings. And he says this doesn't make sense. And once again, I said earlier, I believe rejecting at least partially efficient market hypothesis is the core of value investing. If you believe the market is perfectly efficient, then what are we doing here? What are we doing here? So, oops, one slide too far. So here's some 4 lessons from Greenblatt. Simple lessons, because keeping it simple is probably the first lesson. Don't chase the best strategy. Find a sensible strategy that is good enough and you can follow. Trying to execute the absolute best theoretical plan often leads to abandonment during tough periods. It's hard to make frequent decisions optimally over decades. Maybe once again, if you look back at the charts, the best strategy would be buy whatever stock's going to go up the most every day. You should have put all your money in that stock and then sold it at the end of the day, right? Or you go look at the NASDAQ and you should have bought every dip and sold every top, right? Or anything, you could do algorithmic trading. But if you're doing something complicated that you don't understand, or even if you understand it, if you have to be doing a lot of things all the time over decades, if you're trading every day for decades, you're gonna mess up. It's just not possible. So he's saying you don't need to chase the most returns. You need to chase something you believe in that makes sense, that's gonna give good returns, and that you can execute faithfully for decades and consistently for decades. Number 2, believe to your core, kind of tied to that. Find a strategy simple and logical that you believe into your core and can stick to. True conviction is the only shield against panic and market noise. There will be times when your strategy seems to fail and true conviction is needed to carry on. So if you're just listening to if you're buying things because a YouTuber told you to, or whatever, you're buying things because your friend told you to, if you buying things because an AI told you to, or social media, whatever. When it crashes, when it goes down 50%, you're gonna freak out and say, maybe I was lied to. I didn't get it. I'm an idiot. I'm pulling out before I lose more. I've had some positions where I did the math and I said that, like, this company doesn't need to grow. PayPal, I'll say PayPal, I bought it and it went down, but I'd done the math and it didn't even need to grow at the price I bought it at a lower price. It could shrink and I would make money, and it was doing buybacks, so the low price was good and I stuck with it, and now it's back up because of this buyout thing, and I bought at such a low price, I'm fine, right? And if I didn't believe in it, I'd be like, oh, everyone says PayPal shit, it's PayPal. AMD when it was Advanced Money Destroyer, maybe I would have freaked out, but I knew it. I just doubled down. If I liked it at that price, I'll love it at the new lower price. Anyway, audit your temperament. Ask yourself if you truly have the skills and temperament to beat the market. Honest self-awareness is critical before committing capital to active trading. Most traders who try to beat the market fail. Why do you think you're in the top 5%? So I have reasons to think I'm in the top 5%, and so far in my trading career, I've outperformed the market, but most people don't, and a lot of it is temperament. It really is. So much of it's discipline, so much of it's what you're not doing. And you need to be self-aware because most people, and this is something he stresses, should just do index investing, really. And that's number four. Do you need to beat the market? You can be rich and successful without beating the market. Nearly anyone can become rich by living below their means, buying the index over decades. Doing so has a 95% chance of achieving better outcomes than stock picking, and it's 100% chance going to be less effort, less headache, less stress than maybe not less stress actually, but than stock picking, right? 100%. If you're index investing, you're going to be putting less time and effort into it than a stock picker, and there's a 95% chance you beat that guy. Do you need to? You can become a millionaire by just saving money and putting it in the index. So he asks why. Why do you need to? Even though he did, and I do, that's because he believed that he could beat the index. He believed he was in the 5%. You have to have a reason to believe that you're in that 5%. Otherwise, don't even bother. Okay, on to the big guy, Charlie Munger. Okay, so Charlie Munger, the last one, the big hyped up one. A lot of people through the book are talking about Charlie Munger. They're talking about how hyped they were to meet Charlie Munger, how Charlie Munger gave them all this insight, and now it's time to meet him. And we get a 10-minute interview with him. And honestly, only like 4 questions from that interview make it in. But anyway, he's still a greatly influential investor. He one of the founders of the field of value investing. A really great guy, a genius guy, really. Warren Buffett, who talks about Charlie Munger like he's a genius and Warren's an idiot, you know. So his core philosophy is elementary worldly wisdom, lattice work of mental models, finding great companies, always inverting. He's always talking about, like, instead of thinking about how to find a good company, think about how to find the worst company possible, and then don't do any of that. Instead of figuring out how to 10x your money, figure out how you would go about losing all your money, and then do the opposite of that, you know? So his key career trades, blue chip stamps, sea candies, convincing Warren Buffett to get rid of cigar butt value investing, the sort of net gram value investing of like buying companies with more assets than their stock price, because there was a reason for it, and they both got burned buying a lot of these companies with like a ton of assets or whatever, and there was a reason why the future was not too bright for them, and they got burned. And he convinced them to just buy great companies with great pricing power and great expandability and a loyal customer base and all this stuff. And then his time at Westcoast Financial, he compounded capital like crazy with super concentrated bets on just companies that made sense, that were great companies at great prices. So here's some of his quotes from the book. He has plenty of great quotes I could have picked from outside the book, but I tried to pick ones from in the book. It's counterintuitive that you go at the problem backwards. If you try and be smart, it's difficult. If you just go around and identify all the disasters and say what caused that and try to avoid it, turns out to be a very simple way to find opportunities and avoid troubles. So that's kind of the inverting of him saying, like, figure out how to do everything wrong and then don't do that instead of figuring out how to do everything right. Here's an excerpt from the book that I think really shows Munger's contribution to value investing, I would say, of where he kind of moved the whole philosophy. Buffett credited Munger with curing him of his addiction to cigar butts and establishing the design of today's Berkshire. The blueprint he gave me was simple. Forget what you know about buying fair businesses at wonderful prices. Instead, buy wonderful businesses at fair prices. And this is where they ended up buying businesses that they held on to for 50 years, and they 1000x'd their money instead of always looking for some crappy business for dirt cheap and then flipping it and then looking for the next crappy business until one of them goes wrong. You know, they just found businesses that they could hold on to forever and would always be making great money and always growing. And then another one. Don't pay too much. Don't go for businesses that are prone to obsolescence and destruction. Don't invest with crooks and idiots. Don't invest in things that you don't understand. So this is kind of him saying, if you wanted to lose money, pay too much. Buy into businesses that are going to be obsolete soon or prone to it. Don't buy a business that could get destroyed at any second. Invest with crooks and criminals. Invest with idiot management. Invest in things you don't understand. That's how you lose money. And he says, just don't do that stuff, and you're already at a great start. So here's Munger's lessons that I picked out. Invert, always invert. I think we talked about that plenty. Avoid being stupid. It's remarkable how much long-term advantage we've gotten by trying to be consistently not stupid instead of trying to be very intelligent. So once again, instead of them thinking, how do we be the smartest people in the room, they think, how do we not be the dumbest person in the room? Let's just not be stupid. Let's not make stupid decisions, even if we leave a few smart decisions. They talk about like, oh, we missed out on Google or whatever, or we missed Microsoft, right? But they were worried about not being dumb during the dot-com bubble. And they dodged a lot of BS by not swinging at a bunch of the. If they had bought Microsoft and Google, they would have bought a bunch of garbage too, because they weren't worried about not being stupid, right? Stay within your circle. Know your circle of competence and stay strictly inside of it. It's not how big the circle is, but how well you define the parameter. It's not quite circle comments, but there's a point in there where he says like, well, if I invested in biotech, I'd go insane, and I don't know any of it works, and it's crazy, so I just don't do that. Like, this is not my circle. I'm never going to touch biotech because I'm not that kind of person, you know. Or biopharma, whatever. Build diverse mental models. This was another one, and they talked about a lot in the smaller sections of smaller investors who only got like three or four pages, but you have some models in your head and array your experiences on the lattice work of models. Relying on a single discipline is a recipe for disaster. You know, he's always reading the classics and history and philosophy and religious texts, and you know, he just reads everything. None of it necessarily is going to come up in investing, but like enough of it does, and having enough in your head, it gives him a new framework. And part of what's important is having a unique frame, a unique framework, a unique approach that other people don't have. It lets you see what other people don't, and look in places other people don't, and understand things other people don't, and that can give you the edge. And practice extreme patience. It's another value investing core tenet. Wait for the fat pitch. Most of the time, the smartest move is doing nothing than acting with absolute aggression when a rare opportunity appears. Munger is another one of those high concentration guys, low diversification. Swing big at the big pitch. When the big pitch finally comes, swing like crazy at it, right? Munger was actually a big proponent. Unlike the others, they're not all against leverage. Munger likes leverage. Maybe he doesn't use it anymore, but he talks about like he has a healthy relationship with leverage, and leverage got him where he is. A lot of them, their funds are fundamentally leveraged. They're taking other people's money and investing it and getting more of the gains than those other people, and they have to pay them back a lot of the gains, but like they keep 8% of the gains. So in a way, it's leverage. And Munger, he's used margin. I think he's used options. I don't know, but he's definitely leveraged up and swung big at the big pitches when he sees something he knows. So here's the conclusion. It's kind of a Venn diagram. A Venn diagram PowerPoint looked awful. Let me hide my face cam of the two different camps of investor. I really like the cam up, you know. We'll cover up the thing, but aggressive investors, conservative investors, both value investors, and then the middle, what's universal value investing principles. So the aggressive investors believe in extreme concentration, where the conservative investors believe in broad diversification. The aggressive ones think, you know, I can identify these opportunities and I can make a big pitch. I can make a big swing at the pitch, and I can, you know, get those, like I put all a third of my portfolio in Amazon and held for 10 years, and it made a ton of money, right? The aggressive investors, they believe in aggression, the fat pitch, like I said. They believe in mastering business valuation. They believe in figuring out what a business is worth. And then you can find, as I said, you can find the opportunities that are no-brainers, where something's trading for half of what it's worth. And you know, it just makes sense. Everything's priced in. Anything bad that can happen is already priced in. Where the conservative ones will believe in risk aversion. They might not even be valuing businesses necessarily. I think most of the ones in this book at some point too, but they don't believe that they can value a business, even if they try every now and then. They think that it's unknowable, and they think they're going to be wrong half the time. Aggressive investors believe in searching in unpopular places. Like I said, like bro's investing in Zimbabwe and Nigeria. He said, like, we bought a cement company in Nigeria, and then the Nigerian market shut down for 5 years, and we decided to hope it played out, and it did, you know? Or like, yeah, we invested in Zimbabwe, and then like $1 trillion Zimbabwe dollars was worth 3 cents. But I mean, we decided to believe in the thesis. Although a lot of the conservative ones, they do believe in looking in foreign markets. markets, because I think that our market's overpriced. They get pushed out into those foreign markets where things aren't. Conservative investors, they believe in avoiding failure first. They always think their investment could go wrong. If you're Nick Sleep or whatever, or Charlie Munger, and you're putting 20% of your portfolio in one position, you're not really considering. Even Mohnish Pabrai, he says, heads I win, tails I can't lose much. The conservative investors do not believe in tails I can't lose much. They think in tails it could still go to zero. They think they can make the best, most calculated thing ever, and it could go to zero. So they don't concentrate in it. Focus on not being stupid rather than trying to be brilliant. Even though that's a Munger thing, that's kind of their idea. A lot of them say. But here's the shared core ideas. Rigorous rationality. Stick to a simple, highly logical strategy that you believe into your core, right? They would all say that. They would also, you have to know what you're doing, believe in it, and understand it, and be willing to hold on when things go down. Circle of competence. They would all say, stay in your circle of competence. Don't go too far out. So don't invest in things you don't understand. None of them, no one in this book said invest in companies you don't understand. No one said that. Extreme patience. They all say you have to wait. You can be right, but it takes time. You can be right and it doesn't show for a year or 2 years or 3 years, but eventually it will shine through in the annualized returns that you calculated will be there unless something goes way wrong with your thesis. And if you had enough margin of safety, you should get market beating returns eventually. You have to believe, you have to be able to stick with it for 5 years while the stock keeps going down until the thesis changes. They all say invert the crowd. All of them say that when things are going crazy, when people are buying, right now it would be the SpaceXs of the world or whatever, when people are buying this thing that's maybe worth $200 billion for $2 trillion, stay away. And when people are selling something and I don't know, right now I have like Comcast at 3 or 4 PE, right? Maybe it's not the perfect example. There's some stuff with that, but like when you look at these and no one wants to touch these things, or the spin-offs when no one wants to touch it, that should get your interest. Things no one wants to touch that people are being forced to sell, that should get your interest. They all say that, aggressive or conservative, they all say that. So I think those are kind of the core fundamentals. And once again, I already gave my review of this book. I think it's a great book. I think that it's a great starting point for value investing. I think it's a way to learn about new subgenres of value investing. I think it's a great way to find new people to look into and learn about. I think it's a great way to incorporate new mental models. I think it's a great idea, a great way to learn from the ideas of people who've done really well over decades and understand what they have in common. I think that's what it's about, figuring out what they have in common and figuring out which ones fit you. I think I'm a bit more of the left guy on this, but I learned a lot from all of them, and I think it really helped solidify a lot of my ideas about investing. Okay, so this just to finish off the video. If you got this far, like and subscribe and share the video. Like obviously you've made it. This is probably like almost an hour long video. If you have any suggestions for things you'd like me to do, I've considered, sharing my portfolio. I've considered stock picks. I've considered doing like stock analysis, just picking a stock that I'm interested in and analyzing it and deciding if I want to swing at it or not. I'm probably going to do another book review sooner or later. I like the idea. It felt good. I might do more of that kind of original idea of talking about more big picture thoughts, things I disagree with on, or fundamentals of value investing. I could talk about Berkshire. There's a ton of stuff I could talk about. Figuring out a good idea and then figuring out how to make it into a video. I'm still working on making it into a video. I tried some AI art. I didn't love that. It was a lot of work. The PowerPoint thing, we'll see if it's visually interesting enough. But please leave a comment. Please interact with the video. And thank you for watching. If you got this far, thank you so much for watching. I want to say a lot of work into this, but I read a book and I spent 2 days making a presentation. Then I spent a day recording this and a day, a day editing it. So thank you. And if you want more, show this some love. And I'm gonna keep uploading. I have some more ideas. I just need to work out what works. So thank you all once again. Please interact. Please like. Please subscribe. I'm gonna keep trying to build this channel.